So a client comes in today and told me that she got married this year, and she wanted to know how that was going to affect her taxes. And the client makes about $100,000 a year, and she told me that her new spouse, he makes about the same amount. And she also has several rental properties that she bought with her sister and some other family members. And those rental properties are creating a loss. So one of the first things I had to tell her was that that loss that she'd been writing off, she'd been writing off, $15,000 to $20,000 a year in rental losses. That was going to go away. So she asked why, and here's the rule on that. Rentals are considered passive activities, and there's a bunch of definitions about what makes a passive activity, which maybe I'll go into in a different video, but it's a passive activity with active participation. Most rentals are passive activities with active participation. And if your rentals fall into that category, you can use up to $25,000 of losses from those rentals each year if your income is under $100,000. And that's under $100,000 for a single person and under $100,000 for a married couple. For some reason, Congress chose to, I was going to say not discriminate because it's the same for everybody, but it really is discrimination because the married couple, is limited to, has the same income limits as a single person, but there's two people in a married relationship. So, what does that mean if it's under 100,000? What happens if it goes over 100,000? Well, they have what they call modified adjusted gross income, which is basically all your income, but we don't look at the rental properties. If that's under 100,000, you can have $25,000 in losses. But if that amount is over $100,000, then that $25,000 maximum loss that you can claim gets reduced. And it gets reduced $1 for every $2 your income goes over $100,000. So if your income, for example, is $105,000, we take the excess over 100, the $5,000 divided by 2, that's $2,500, and subtract that from the $25,000. The maximum rental loss you can claim is $22,500. Now, when your income gets to $150,000 or above, you don't get to claim any rental losses. They get carried forward. And you can carry forward those rental losses forever. There's no limit on how long you can carry them forward. And you can use them when you have rental income in excess. When you don't have any losses, when you have income, you'll get to use them. Or if you sell a property, you can use them. If the property that you sell has negative, it has some passive activity losses from prior years, you get to use them when you sell that property. Now, this is something you have to be really aware of, especially if you change preparers or you're doing your own return. I've seen several cases. One time I had a client with over $1 million worth of passive activity losses that he hadn't carried forward from the operation of an apartment building over about a 15-year period. Most of it was from depreciation, not that he really lost $1 million. And the preparer that he'd been using, for some reason, the way he did his tax returns, he didn't track that amount. And so the client lost track of it, and the apartment he'd sold and bought something else that was producing a lot of income, he ended up paying an awful lot of tax. Luckily, he responded to one of the mailings I sent out, and we were able to go back and figure out what those losses were and recover them and recover quite a bit of income tax that he paid in the previous 3 years. So that's pretty much the story on passive losses. Something you really need to be aware of if your properties are losing money, to make sure they're getting tracked. You know, everybody has questions about income taxes and finances, and I have answers. Thanks for listening.